So Jim, you started like mid 80s, right? Where did you start? Did you start at Wells or where did you start somewhere else?
No, I grew up in small farm town in Iowa on the eastern side, close to the big metropolis called the Quad Cities. Well, that's where I used to hang out on the one-ways at night in high school. But no, I went there. Then I went to college. That was my academic research was what's the farthest away from home state school there is. Because I can afford a state school. And that was the farthest away from home was Iowa State. So that's why I went there. And I ended up going all the way through and getting a PhD there in economics.
Wow.
And came out in 83, I guess, at the start of 83. And my wife was from Iowa, and I had a change of heart. I was going to go in academia until the very end, and I had a change of heart. Decided I didn't want to teach and do that. So then it was like, we wanted to stay in Iowa. What do you do with a PhD in economics in the great state of Iowa if you don't teach? So I found a little regional brokerage firm over in Cedar Rapids who the current guy who ran it, he was the son of the founder that founded it in the mid-1930s during the Great Depression. And it was still open. And he had just started an advisory business because he was worried the commissions were going to go away, but fee-based business was a way to go. And so he brought me on. I didn't know anything. I remember my wife, we went over to the interview, drove over, she drove, and I stopped at some kind of dime store there and got a book called How to Buy Stocks.
Yeah.
And I was reading like a madman all the way over because I don't know anything about it. And I read about this really interesting thing called a price earnings multiple, which I had never heard. This is a freshly minted PhD. I'd never heard of it. And so it was pretty obvious I probably knew about nothing when he interviewed me, but he hired me anyway. So, and that's where I started. I was probably there for about 8 or 9 years. I was actually president of that advisory company once I turned, I guess, 28 or 29. I learned a lot from him and that organization, not only about asset management primarily, but running a business and all the different aspects. I started writing a newsletter right away in 1983 and have written one ever since. And he would finance a lot of research. And I went from there to a firm in Des Moines with 2 other partners. They were about a $2 billion stock and bond shop. That's where I learned bond edge for the first time.
Okay.
I educated myself a lot on that. And then I got a call from Norwest.
Hey, Jim. Mind us hanging? Because I think actually, Jim Warden, we're going to want to have this part as a part of the actual recording of the podcast. So I think
I thought we were going.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Everyone, welcome to episode 5 of The Bull of Wall Street. I'm Jimmy Lee, CEO of the Wealth Consulting Group. My co-host, Talia Leger, Chief Market Strategist, and Jim Warden, our Chief Investment Officer. Today, we have on a legend in the business when it comes to economics, markets. I grew up watching, when I say grow up, we're just joking about both of our ages, but we've been in the business, both of us, for a while, but watching him on TV a lot, and on CNBC, I would watch a lot of Jim Paulsen. And so we're very happy to have him on. I'm going to let Jim Warden, who invited Jim Paulsen on the podcast to kind of start this out and get into some of the questioning. And Jim, go ahead.
Yeah. Well, so great. This is awesome. We're super happy to have you, Jim. So we were just talking a little bit before we officially kicked it off about, kind of your background in Iowa and where you were working and you were a PhD, PhD in economics, and you worked for a small shop there in Iowa, and then kind of take us to that point. You mentioned Norwest. I know Norwest was bought. Well, actually, Norwest bought Wells Fargo, I think. but the name, they like the Wells Fargo name. So I started in the business in financial securities in 2000. I moved over to Wells Fargo. You were the guy there back then. And I just remember everyone was super bullish, going gaga. It was a tech bubble. You were actually pretty bearish back then. And you were saying,
99,
hey,
99,
companies need to make money. You can't just buy pets.com, things like that. So kind of take us through that journey from Norwest all the way to now. I mean, you've probably seen a lot of ups and downs, but take us through that.
Well, I had worked, as I said, I worked at a place in Cedar Rapids, about $1 billion value stock shop was my first job. And you kind of cut your teeth on that. And it took a long time for value to die out of me, over the years. But I then worked with a couple of partners for about a $2 billion stock and bond shop in Des Moines. And I'd worked with relatively small firms up to that point in my entire career. And then Norwest called one day, as you said, Jim, and I was kind of attracted to the idea of heading up a whole research unit, a whole bunch of professionals that were equally excited and passionate about the art of money management. And so they attracted me to go north to cold Minneapolis, which when you're in Iowa, that sounds cold too, even though Iowa's about the same. So I went up there, and to your point, I think I wasn't there very long. I maybe at most a half a year. I think I went up there 97, right at the start of, in January 97, at the end of 96. And maybe within a half a year, I can't remember for sure, but I remember waking up one morning on a business trip in Scottsdale, 5 a.m, and I reach over and I pick up my phone, look at Bloomberg, and there it was. Norwest buys Wells Fargo. So I was just starting to, get my feet wet up there, and I thought, oh my gosh, this probably isn't good. But as it turned out, all the management people basically here in Minneapolis, Dick Kovacevic and the rest of them, most all of them, moved west, warmer climates, California. Dick was, he went to Stanford, so he was more than inclined to go back there and take it out. But there was a few of us guys that just wouldn't leave here, and I was one of them. And as it turned out, it worked out okay. I had, I don't know how many years, 20, maybe 21 years I was there. And anyone who's worked in large organizations, there's a lot of ups and downs and a lot of days when you wonder if that's your last day. But I was lucky to get through those for the most part. And I obviously had some tremendous experiences. I went from where, we're basically my career working with a regional money management firms, essentially, a lot to the brokerage community at building business. And then all of a sudden had a not only national, but global scope. Went everywhere and met all kinds of very, very, very interesting clients and ultimately other investment managers, very talented, impressive people over the years. And I had just, I fell in love with economics at Iowa State. I was a philosophy major for a while. I was a social work major for a while. And then I found out I loved econ, I loved math, but econ, all the major economists were philosophers. I mean, it was Ricardo, John Stuart Mill, Thorstein Veblen, all those guys were philosophers. That's what they were. And they're the father of economics. And that was before anyone knew that you could use math in economics. And then, of course, it changed everything. But I love that, and I still to this day love it. And just by happenstance, falling into the money management business I'll always be thankful for that. I was gonna go to the CIA at one point when I came out of grad school, and
wow,
that guy told me it was okay if I smoked dope. That that they'd let that pass, and I'm glad I didn't do that. And I just, to this day, even now, I'm retired really, but I'm just having fun and still writing regularly, and I just can't. There's always another idea I want to look at. There's another edge I want to investigate, see if there's anything there that investors can use. And most of them don't work out, but as you guys all know, it's an endless onion, which you just cannot peel.
Yeah.
And if you ever figure it out, guess what? It changes.
It changes all the time. It feels like
it does. So it's been real privilege and a blessing to do something that I really loved most of my life. So,
That's awesome. When you were at Wells, did you know Galen Blomster?
oh, absolutely. The
He was, I think, credited with discovering the yield curve and like had all these models. And I remember I was a new advisor. I'm like, this is incredible. I felt like Wells had like a really deep bench. You and like Galen, and I think there was some other folks that were doing the whole minimum volatility, learning about that factor.
Galen office just down, maybe 2 offices down from me most of our time at Wells. And he was the first guy to write about what they, I think at that time called the Blomster barometer. And it was the yield curve. And he wrote about this in the 70s, I believe, and it was in the New York Times. And several on Wall Street, including Ed Hyman and others, have said that, he's the first one I ever saw. He was a character. He still is a character. I think he likes hunting and fishing a little better than economics at this point. But he was, I learned a lot from him, among others there. But yeah, you're exactly right.
You mentioned
it's
Ed
hard
Hyman.
to imagine.
He was my boss for a while.
Was he?
What?
Yeah, I was at ISI.
You were? Okay. Yeah.
I was going to say, it's hard to imagine not having the yield curve. I feel like everyone's looking at the yield curve, and sometimes maybe they're looking at it too much. Like, whoa, the yield curve did this, then we're going to have a recession.
Yeah, I mean, that yield curve, I think the reason it wasn't discovered until the 70s was because it really didn't work until the 70s. And then it worked fabulously during the 80s and continued to work well in the 80s and 90s. And until, as we all know, until this post-pandemic cycle, when it and almost every other recession indicator known to man has gone totally over the edge. None of them worked.
Yeah, this cycle, I'm surprised to actually hear people trying to take credit for the yield curve or the invention of it, because everyone's saying it doesn't matter. But that happens every cycle, doesn't it, Jim?
Yeah, it does. And yet, what I find is that, you find these golden indicators that work so well, and then till they don't.
That's right.
And that's happened over my career, 40 plus years of having something. I remember when we'd all wait with bated breath in the early 80s for the Thursday afternoon release of the M1 money supply figures, because that was just correlated so dramatically with the markets. I can remember that it was all about the dollar in 1985. I can remember when it was crude prices at the start of the 80s, and then all of a sudden that doesn't even matter anymore. And that happens over and over though. But I would say, to your point, Tally, that the yield curve was one that lasted really several decades.
Yeah.
Maybe it's still in force. I don't know, but it's certainly been broken now in this recent cycle. We'll see if it comes back into play again.
That's right. So should we get into a real question here, JW, or?
Sure.
Well, Jimmy, do you have any? Jimmy's always got some really great questions up his sleeve.
Okay, Jim, I'm the only practicing financial advisor out of the 4 of us. So I think for us, when we're dealing with clients, we're relying on people like you guys and hoping that you guys know what the heck you're talking about. And it's fascinating, what you just said in terms of how, sometimes things are different, right? And it's a dangerous thing. I can't remember who was it Sir John Templeton that said that, or I can't remember who was the one that said this time's different. I don't know, whatever. So I guess it's dangerous to say that, but this time around, what do you think really happened this time? We had a few other economists on our earlier podcast that kind of chimed in on their view of that. And I'm sorry if I took one of your questions, Tally or Jim, but that I'm just curious to know, like from the 3 of you guys, I know where we stood at the Wealth Consulting Group for the last 2 years and what we were paying attention to, but we're curious as to what you were thinking.
Well, first, I think it's different this time a lot of the time. Almost every cycle there's something.
It's always different.
Yeah, it really is. I mean, there is things that rhyme and stay there throughout, but there's always different. I mean, you got to remember in the 1960s, we had a constant real interest rate, around 2% like gold. And that's when we thought by the end of that decade, we'd solved the economic cycle. We went the longest period of time without a recession. All we had to do was tweak it now. And, that was the popular belief of the day. Monetary velocity used to be bounded until 2000 in a very narrow range, and now it's gone straight south. I could go on. There's just a number of things that always changed that were golden for quite some time. So it is true that you can say it's different this time than it still isn't, because you still have fear and greed, and you still have booms and busts, and you have pessimisms and to frothy optimisms. The thing that keeps it the same throughout, the only thing in my view, is one thing. It's the human that's the same. We're all born with fear and greed, and that is what the primary force driving through everything is. All the other things change, but that element doesn't. That's what keeps it rhyming. But to your point, Jimmy, I think it has been an interesting cycle this time too. And I'll take us back to the pandemic. And first, the pandemic cycle in its own right, the pandemic was kind of, it was an absolute unique crisis because we had polio and other things in the past. But really, at least for the current generation, that was a pretty unique deal, man. It was kind of like major financial crisis all wrapped up with like a death count on domestic soil. I mean, it was really something. And we, not only that, but we had to all go off and stay in our own homes for a while, and isolation. And there's a lot of stuff that was pretty weird with that. But I think what's left this thing really out of bounds since is, I've written a lot about this, about the backwards Fed. And what I mean by that is, I think inflation bottomed out in the May of 2000. It started to take off. And of course, it went up from about 0 all the way up to 9.1% by June of 2022. The Fed, if I go back historically and look at what the Fed's done in post-war, whenever there was a rise in the inflation rate beyond just anything over a blip, the Fed would be tightening almost throughout that period of time. And then when it disinflated, they'd be easing throughout that period of time. This Fed, throughout its entire existence since the pandemic, has been easing when everyone else is tightening when everyone else is easing, and they're doing it now. Again, now they're easing while everything else is tightening. And that has been the rarity of the post-pandemic cycle, where we've totally delinked the Fed as its own animal from all the other policies. Now, as investors, I think the public certainly, but even investors, I think, give the Fed far too much credit, because they have press conferences, they're on TV, and they have regular meetings where they tell us things like, the vote count or whatever else. But they really only manage one little policy, directly, and that's the Fed funds rate. There's a whole array of other things that are managed really by you and me in our decisions that we make, by the independent decisions that people make every day, the 300 million independent economic agents. And I'm talking about the money supply. The Fed can affect it, but we kind of control it depending on our liquidity preferences and how fast we want to turn something over and those kind of results. Fiscal juice is outside the Fed's purview, net fiscal juice, and a lot of that is driven not by the congressional authorities, it's driven by the speed of the economy. When it slows down, fiscal juice expands. When it speeds up, fiscal juice contracts. It has nothing to do with congressional changes or pros or the executive branch. Then you got the dollar, which is an animal all to itself. Don't forget about things that people don't think about. Inflation itself is a huge contractionary force or a stimulative force all by itself that's out of the purview of any policy official. So what we do is, there's an old adage that says, don't fight the Fed. And it was a good adage over the years, no doubt about it. But I'll tell you what, it's been terrible since the pandemic. Because in 2020, when inflation took off, everything else started tightening. Bond yields took off, okay? The money supply started to contract. Fiscal juice started to contract. The dollar tightened and rose, but the Fed didn't do anything. In fact, the funds rate was still 0 in March of 2022, when inflation was like 8.5%. They basically waited until inflation peaked to finally start tightening. Well, guess what happened when inflation peaked? Everything else started easing. So the money supply started to pick up finally again. Bond yields quit going up. Actually, I think they would have come down if the Fed would have let them, but they at least stopped going up, if you will. You had the dollar weaken off again over that period of time. And don't forget that the inflation rate coming down itself was a huge stimulative force. And now what's happened is Since the Fed finally started easing in mid-September, what's happened? Bond yields have gone up, like 10-year yields have gone up 1% since they started. The dollar's been strong again, really strong in real terms, up 6%, I think 7% maybe since February over that period of time. Money growth has been rising yet, but money growth sits at 3% year on year with nominal GDP at 5%. It just is an insufficient money growth for a 5% growing economy. If we keep it there, real GDP is going to slow even further. So what I think has been interesting is the Fed's been chronically tardy to the party, like 3 times over, and yet nothing bad's happened. How is that possible? How can the Fed make 3 mistakes in a row and everything works out? Economy keeps going, the bull keeps running. Well, I think this is why. While the Fed didn't tighten until like April of 2022, money growth went from like 27% to -3. Fiscal juice went from 18% to 3.5% of GDP. The dollar went way up, as I just mentioned. And all of those tight forces is what peaked inflation. Do you think the Fed raising the funds rate from 0 to 1% by the time it peaked is what killed inflation? No. I think it's all these other policies about 1 year lag later that finally peaked it out. Then inflation was decelerating the whole time. How did we avoid a recession when the Fed waited till September of this year to finally ease? How did we do that? Because everything else eased over that period of time. It kept us out of recession, even though the Fed was on the other side. And now the Fed is easing, but everything else is tightening. And I kind of think what's going to happen is we're going to slow down. I think we're going to avoid recession, but I think we're going to slow down in the next year, here in the first half particularly. And I think it's because when you jerk rates up like we have at long rates, you jerk the dollar up over that period of time as well. You keep liquidity growth below the pace of nominal GDP. Those are tightening forces. In retrospect, the Fed has been really unimportant and indeed more than covered up by very appropriate free market laissez-faire policies, in my book. I really think that's the way it should be done anyway.
Yeah.
I think, economics-wise, it'd be great if there really wasn't a Federal Reserve or the government to muck things up as often as they do. But I understand the need for all of that. Fine. And what's a beautiful thing about this is that here the Fed can pretty much do what it wants, and the free market will adjust appropriately to make sure that they stay on the rails. And I think that's what's different this time.
Darn it, guys. I did a Fox business interview this morning on Maria's show, and I said, don't fight the Fed. I wish I would have had this podcast before I said that. That last deal that you just did for me as an advisor was phenomenal.
I don't know if it's right. I mean, you're not going to read this in the Econ 101 textbooks, Jimmy, or the CFA manual or anything. I just, my first place I went, founder sent me to New York right away. And then I went out there and I saw Ed Hyman, CJ Lawrence, and some others. And for me, at 25, that was a big deal. And like he said, those are guys just like you, up your own mind. At least when you're wrong, you'll know who to blame. And I've always gone with that. But the problem is when you do this analysis, sometimes you're just wrong too.
Yeah. But to me, as an advisor listening to you, it makes sense. I'd love we're doing pretty good, guys. We have 2 Jims and a Jimmy.
Yeah. The Jims.
But I'd love to hear you guys weigh in on that, JW and Tally. Weigh in on what he just said. And
can I get into the conversation there? That's probably
go for it, Tally.
I'll call you JP if you don't mind. Actually, you said CJ Lawrence, so they actually rescued that name. I don't know if you're aware, but that's their asset management arm.
Well, I didn't know that. I did not know that.
Yeah, it's pretty cool. So I think it's like a family office
when I went out
basically.
There. Yeah. That's interesting.
But just let me just take a minute to kind of just say, Jim, it's nice to finally meet you. I've been aware of your presence, of course, in the industry for the past couple of decades, especially at Leuthold. I don't know if that name came up, but Malden used to make a big deal out of you when you were there.
At Leuthold?
Yeah.
Well, Leuthold, I know, I met Steve very early on in my career in the 80s. In fact, when I showed up at the first shop in Cedar Rapids, my mentor there, he gave me that green book.
The green book. I remember the green book.
Green
book I love
from
the green
Steve,
book.
From Steve. And I knew Steve for years. And
do they still do that green book?
Oh yeah, absolutely. They do the green book. Yeah. I knew one of the co-CEOs today, Jeff Leadholm. I think right after I came to Minneapolis, I had met him, and we've been friends for over 20 years.
Yeah.
And so when I came out of Wells, he'd always said you can come over. So I had the great luxury of just going down the street to Luthold there in the last few years when I worked. And Steve was out by then. I mean, he was still alive, but he was out by then. Their chief investment officer, Doug Ramsey, worked with me in Cedar Rapids, Iowa, many, many moons prior to that. He was this mentor in Cedar Rapids. Every year would hire the brightest kids that were like juniors in high school. He'd find them and bring them in as a summer interns and stuff. Well, Doug was one of those. This is back in the early 80s.
Yeah.
So he came in as a summer intern, and I'll tell you what, these kids, including Doug, scared the crap out of me because I had a PhD, and here's this junior in high school come in. He could probably run circles around me. I mean, they were just brilliant. But Doug and I always kind of stuck over the years, and so we ended up working together too at the end.
That's great. I know we're dropping names a bit here. I guess we'll keep going. I think we have some friends in common at Alpine Macro as well, and of course, anyone worth their salt in macro knows graduates of the BCA school of doing things. So.
Yeah, I go back a little ways with them as well, and over the years, and spoken at their conferences and stuff like that. And now there's the Alpine conference. I generally speak once a year at that. Now it's just kind of fun. Like the only trip I've made on business in the last 12 months is I went to New York to speak at the Alpine conference in September.
I think I saw that. Well, so that's probably a good segue. I'll just kind of lead in here with a question about the economy, growth, and the Fed, because you were just talking about that. Common ground, maybe where we differ. We do, it seems, share some concerns about growth in the new year. For my part, and I've been talking and writing about this, it's jobs related. And I saw that you kind of raised a yellow flag about these rising 10-year Treasury bond yields. I did the same vis-a-vis stocks, a little bit different angle, but and I'm just looking at my phone here. They've crept back up over 4.5%. So I get your concern and the argument that higher bond yields today mean slower growth for tomorrow. That resonates. So look, my basic view is growth, and we get a scare related to jobs, as I said, should produce some of these long-awaited buying opportunities in stocks. But what do you think? Am I being too optimistic? Are recession odds rising meaningfully here? And to your point, is the Fed making a policy error by taking a couple cuts off the table? And should we really be getting more defensive from a sector perspective?
Those are all really good questions. Here's where I'm at. I mean, the answer is none of us know. That's always the risk. There are periods in this business where I think it's an easy decision. If you're in the midst of the bottom of the 2008 financial crisis, it's real easy to say, time to be bullish, man. I don't care how long it takes another couple months. Who cares? Because once it goes, it's going to be, and then you get through a period, it's just pretty easy layup. But a lot of the time we spend like we are now, Tally, to your point, is where it could still go up for a while, but there's reasons where it gets a little more iffy, and these are the really difficult times to make decisions exactly what you want to do. I look at this is where I'm at. I see a lot of policies, not just rates, dollar, lack of money, supply growth sufficiently, all of which I think are likely to slow the economy down. If you look at a chart of the Citigroup Economic Surprise Index, and with bond yields, the 10-year, if I push the 10-year forward by 3 months and then lay it, they look really similar. The bond yields, if you invert it,
inverted scale, yeah.
Yeah, and it's very similar. And so the bond yield movement is likely to bring it down. Surprises, I think, are already at 5. A couple of weeks ago, they were at 45 plus. Now they're plus 5. I think they'll be negative 15, 20 here in the first quarter, maybe even by late January. And if momentum slows that dramatically, then I think we're going to get GDP growth falling to around 2%. And the thing about 2%, that's that stall speed that people worry about, and that'll come up again. But I think
growth
just
recession, is that the right term?
The what?
The growth recession?
Yeah, you're right. The old growth recession idea. Yeah. But it's a scary thing. And to your point, think about the unemployment rate at 4.2. It's already come up from 3.4 or 3.3. It's by that much in historic, we should have already had recession.
Yeah.
And we're outside that bounds with Sham rule and like. But, just imagine if that goes up another 0.2, or what if it hits 4 or 5? Yeah. What do you think is going to happen? I think we're going to have a big increase in recession fear coming right back.
Yeah.
We had it almost the entire time since this bull started. Chronic recession fear. I like that. Just not, we could climb that wall of worry and just not worry too much because everybody else is so worried. And that now it's gone away. And that's where we might have some problems until we restore that again. But I think that's what's going to bring it. The question is, what about a real recession? And my take is that all the tools that forecast recessions, leading economic indicator being negative, the yield curve being negative, the Sham rule, that take your pick, none of them worked. So I've kind of gone away from that at indicators of recession. I've looked at 10 of them. I think that all of them have blown apart. And here's where I'm at. A recession is more than about the pressure put on. It's really the vulnerability that exists, I think, is the most important ingredient that we certainly don't totally overlook. But this time it might be more important than ever. And what we've been doing really since the 2008 crisis, and we've been chronically lowering debt to income ratios, debt service burdens in the household sector, while at the same time taking up net worths and taking up liquidity holdings. And it's been very difficult to recess that mother when 2/3 of your economy is totally worried about recession and totally prepared for one all the time. Liquid, they got equity, they paired their debts, no one borrows money anymore. That's kind of what they're doing. And the corporate sector is about as good, not quite as good as the household sector, but I know that total equities to debt are at record low, net cash flow to GDP is close to record highs, and just the attitudes. I mean, look at the poster child for recession in the post-pandemic world being Jamie Dimon warning us every morning that some cataclysmic event would happen before the end of the week. I'm being, suspicious there. My point is that I think we still have too much pessimism. The University of Michigan Consumer Confidence Index, I think, is lower than like almost 80% of the time right now, going back to the 1950s. We just don't have recessions when pessimism is that pronounced. I look at a chart of consumer confidence and I mark where all the bear markets started, they all start up 100 or above, and we're sitting down here like 70. And it don't happen down here. And it makes sense. If everyone's pessimistic, no one's out over their skis in any way, and there's nothing for the recessionists to bite to bring the system down. And I think that's where we are today. That doesn't mean you can't slow down, speed up, whatever.
Right.
Full-fledged recession seems unlikely. Now, all that said, watch, we'll recess tomorrow. That'll be that. So there's there's no surety of that, but that's where I'm at. So when I think about putting those two things together, there's a lot of positive force for this equity market, a lot of positive force that could still come. The Fed could drop rates a lot further. Let's say inflation does fall to 2. I think it's actually going to go down to 1 next year.
Wow.
So
alongside a recession,
commodity prices right now are, it sounds like a recession.
Yeah.
Commodity prices are already off 35% from their highs during the pandemic. And if you look at crude oil or gasoline prices at the pump or just the SPGS commodity price index, it's sitting right on, if it goes any lower at all, it's going to be like a 3.5-year low for all this. Okay? And with that real value of the US dollar right now, it's at its highest level since 1984. It's sitting just a few percentage points above its highest level it's ever been at since we free floated the currency at the start of the 70s. That's a powerful disinflationary force. If I take the ratio of the factory utilization rates divided by the real value of the dollar, that's going straight south for a while now. Factory unemployment's rising, and dollars rising, and that's putting big time downward pressure on price structure. I
agree with that. I know like some economists dismiss the import price component because it's small, but directionally, I think it matters.
I think it definitely matters. And it's not just the import prices. I mean, people that are just involved in domestic goods and output, sales are all done here, are still radically impacted by competition from abroad. Even though they don't trade overseas, it still filters through and meets that. But I just don't see the inflationary force. I think it's negative still on a cyclical basis. If I look at the tightening pressures that are coming on it, if I look at real GDP maybe slowing from 3 to 2, that's going to take a bite out of it. And then there's still all the secular forces, things like aging demographics. Our labor force is growing barely 1 rather than 2% in the 70s. More international openness. The fact that we are led by a sector that uses disinflation called technology, where it used to be led by the auto industry that oozed sticker prices go up every year.
And the softening in the housing market too. That was a stubborn and sticky component. That's
right.
Hey, Tally, can I ask you guys a question about that? I've been, I actually dug into how the BLS does that data, right? And it's a huge portion of core CPI, like 40% or something, I think. I mean, that's not real-time data. So when you look at some real-time rent and things like that, being such a huge weighting in the core, is that into why you think it could go as low as 1?
It's not a big part, Jimmy, of what I'm thinking, but you're right about it. It's an impact, a lagged impact that's going to go in that direction, if you will. I just think the cyclical forces and the secular forces are such that that's going to go down. But I just look at the positive force for stocks here, just real quick. Disinflation is a huge positive for stocks. When you disinflate, I don't know exact numbers now, but back to 1950, something like stocks go up like 12% when it disinflates versus something like 5% when it inflates, okay? Something like that, big spread. If I look at confidence, I mentioned confidence, this is a big one. All the months when confidence rises versus when it falls, the total return of the stock market goes up 20.5% versus 5.5%.
Wow. Big difference.
Big tailwind for multiples.
That is, it's huge. And that to me, I just wrote about the biggest untapped asset in this bull is if somebody can revive confidence. It hasn't happened in 4 or 5 years since the pandemic. But if we can do that, there's a lot of juice left in it. Money growth is a huge positive. It's been rising and helping, but it's still very low. And every month it rises year on year versus falls, it's something like 16% versus 2% in terms of what it does for stock. And then I haven't even mentioned what if rates come down or bond yields come down.
Can I jump in?
And earnings stay positive, then
hold on, Tally. So while we're still talking about money supply and all that, I just have to ask, because I'll probably forget later, all this money that went into M1, all this money that's in money markets, isn't that like a lot of fuel to keep this thing going, both spending as well as money going into bonds and money going into stocks? But then I guess my worry is, do we have a melt up that's like 2000 or 2021 where there's just a lot of speculation? What do you think? Or are people going to save because they, demographic changes?
I wouldn't be, I think there's a lot of fuel there. We almost got $7 trillion in money market funds, which puts the money fund to DPI ratio, to income, disposable personal income, almost to the record high that it achieved in the pandemic. And you just think about that. We have a money fund to disposable income ratio right now that's higher than it was at the worst of the great financial crisis in 2008. It's a lot of juice.
Wow.
That's left over. Now, I think one of the reasons that small caps have not performed is because
I was going to ask you about that.
Yeah. During this entire bull market, money funds to DPI ratio has been rising. And those are funds that generally find their way to liquefy the smallest cap part of the marketplace. If I look back historically, when small caps do well, when money fund to DPI ratio comes down, it is when they start to pull funds out of there. Well, it also didn't help that the Fed kept raising the money fund rate throughout this bull, and until September, this is the only bull in post-war history where the Fed tightened throughout its entire existence. It started in October of 2022, and until September of this year, it was a total tightening. And I think that's why the smalls have done poorly, because it's been a bull with tightening, the only one we've had. And then one of the fallouts of that is money funds. But here, if the Fed's finally going to lower rates, then we could start to see some of that money come out of there. And to Jim's point, I don't know. I could see this thing getting frothy at some point. Yeah, because as I say, inflation comes down, growth's still there. You got money growth picking up. You got excess liquidity balances laying around. Their confidence improves. People finally get to feel some animal spirits, activities on Wall and Main. So I could see it, but we're a long ways from that at the moment.
Well, and the top companies now are making a lot more money than like the top companies in 2000, right? I mean, that's a night and day, right?
I went to the opening, it was near the opening of the San Francisco Giants ballpark in 2000 or 99, whatever it was. It was right around there. And I remember going to this game. It was one of the first ones they had. And I was almost appalled. I'm a big baseball nut, but I was almost appalled because I walked in. It looked like a single or AAA ballpark. It had advertisements all across the outfield wall and that kind of stuff. Well, the whole stadium was loaded with advertisements and signs, and they all had .com in the name. There's just tons of them all over the San Francisco Giants' new stadium. And I did think at that point, man, this is, I don't know, it's kind of like, the cover of Business Week or something. It's not good.
Hey, JP, I know JW changed the subject on us, but that's okay because natural conversations are messy. I wanted to get back to Jimmy's, of the three Jims. I got to keep them straight here. Jimmy's question about housing, as a component of inflation. Campbell Harvey wrote about this, and I actually looked at it when I was at Raymond James last year. But you can actually decompose the CPI, and when you use, pick your favorite realistic measure of housing or rent inflation. We just went to rent.com. But if you swap that in and you use the weights, then they provide them on the BLS site, you're actually running well below 2%, well below the Fed's policy rate. And Jimmy, that just gets to this whole issue of, and everybody knows about it, this very nebulous owner's equivalent rent, which is highly theoretical. It's not realistic at all. It doesn't make any sense. It's a known problem. It's a measurement problem in economics, Jimmy.
I think they call 50,000 residents every 6 months or something like that, isn't it? I don't know. That's what I read.
Is that what they do? I didn't even know that.
Yeah, 50,000 people they call every 6 months. So it's a 6-month lag, I believe, is the way they do it. But anyway.
Doesn't seem very advanced.
No.
Don't the Fed members know this? Obviously they're people like you guys that are on the committee. Come on.
I would think they would. I don't know. I really believe, like when I started, I know this is taken back, but 1983, there was literally a handful of economic reports. There was one inflation, maybe two inflation reports, a jobs number, basically, industrial production. I mean, you just had the handful. Today, how many of the same report do we have? We have 100 inflation numbers, and every one is gut-wrenching when my gosh, that went up a tenth. Oh no, it just literally, it's almost like overkill. It's like you almost have too much information, and it leads you down a bad path sometimes. When you just sit back and, even to Jimmy's point, and just say, well, look, that there's that data, but it's 6 months out of date, and everyone knows where it's heading, and what's the mystery at some point.
Well, did you see Jim Paulsen? I think it was Friday. The Fed's favorite core PCE deflator was actually very well behaved.
Yeah, it was. I don't spend a lot of time on the Fed because I think they've kind of been upserved by and large. And I don't know when this was. It was before I retired, but I went back and looked at all the Fed meeting dates, in the last few years, maybe the last 5 years, I don't know. And I took the Wednesday release and the 2 days before and 2 days after. And what I found was that during the 5-day window around the Fed meeting, that stock market returns were negative and the VIX was high. And then all the rest of the time, stock market was positive and the VIX was lower. And I kind of thought, why don't we have a Fed presser? Do we really need that? just to great VIX and negative returns. It just doesn't do much else. This last one was just the same. What do we do? This whole sell-off we're in right now, you could say it's in the 5-day Fed window. Now what are we doing? Kind of slowly.
If you think that inflation is going to be a lot lower than expected, where would you see the 10-year yield a year from now?
Yeah, I really think the 10-year yield, you're going to see that closer to 3%.
Wow.
I'll take it.
I really
love it.
I will
take it too.
But you also got to look at, what happens, whatever. I think the Fed's been holding up the bond yield far higher than it normally would be for quite some time because it's been out of sync with everything else easing in the chart. So I look at a number of different things. If I overlay the 10-year with commodity prices, with real crude oil, with the copper gold ratio, with the nominal GDP growth rate annual, the bond yield looks way out of sync right now.
Way out of sync.
All those things, all of them, way too high.
And to your point about, like sentiment.
Fed wasn't holding them up. I wonder if some of this already would have happened as a guess. So there could be
sorry to cut in there, but to your point about sentiment positioning and human beings in the marketplace, bonds are a great example of that right here. There's too many bond bears. So I think you're right, at least tactically.
I don't know. And, but that's kind of where I'm at. I also think that, not only if inflation come down, that make a big difference, but I also think that if the GDP growth starts to slow, if surprises go negative and GDP growth starts to slow from 3 to 2, or even if the GDP now number from the Atlanta Fed all of a sudden starts printing 2s, in the first quarter, if people adjust it down to from a 3 to a 2, I think the Fed will give up on pausing their easing pretty quickly. I don't think inflation is going to matter if growth falls, or if the unemployment rate jumps another 1 or 2 tenths. I think that'll take the juice out of their pause campaign as well.
Are they keeping rates high by doing the quantitative tightening, selling bonds off their balance sheet? Is that the way they do it?
No, I don't really I see no real correlation between their balance sheet and much else, if anything, tell you the truth. There just isn't a really consistent relationship there, not even with the stock market.
Well,
so
that was a stock market indicator 2 cycles ago. And then I just stopped following it to your point.
The Fed put, right?
It just hasn't worked out that way.
Yeah.
I mean, they obviously can hold the funds rate wherever they want to hold it because they just declare it, but I think the Fed, wanted to ease and they started. I think they felt they continued, but there was an uptick in inflation reports. And I think this Fed's been hyper sensitive to the latest report. For someone that has to take, just like investment managers, if we're not a trader but a manager, much of what goes on in the interim, you just, okay,
yeah.
So what?
It kind of sounds like the way that everybody complains about their accountants, or they're doing everything in arrears, right? And looking at the rear mirror. So if you're right about that and inflation's lower and yields go down, don't you think that probably the biggest potential tailwind could be lower rates for the consumer confidence factor that you were talking about? I mean, rates going down, if the 10-year is down closer to what you were talking about, then that's going to affect mortgage rates. It's going to affect auto loans. It's going to affect all the stuff that affects consumers, monthly, right? So I read your blog this morning and you said, yeah, we could get some volatility but we're going to end up the year, could have a pretty good year, 10% next year or so. But if things really, went the direction you're talking about and consumer confidence goes up, do you have potentially a higher bullish mark that you would call?
Well, the reason that I put that at 10 this year is there's some things I'm just on the fence about, and I hate being on the fence. I just don't know, because the reality is you're not on the fence. If you're on the fence, you're just not making a decision, and it doesn't get down to the portfolio. So you made a decision when you're on the fence called no decision, and I don't like that generally. But I'm still trying to figure out, to me, this question, Jimmy, and if we slow down from 3 to 2, maybe even a little sub 2, and maybe the unemployment rate jumps a little and people get really worried about recession, you tell me what the Mag 7 and S&P 5 tech do. Do they still become a defensive asset of choice? Right. Or do they pull back big time like they did in July, because people bring up .com again and whatever else and concentration and all those things. I don't know. I don't like the solution, but the solution I chose, the indecision on that issue, is that I think I'll put the S&P at 10. And if I'm generally right about how this plays out, I think the broader markets do a lot better.
Yeah.
So malls and value and
mid cap
do a lot better than that, but the S&P might not. But it's kind of a, excuse the phrase, a chicken, way out.
I like it.
Yeah.
Well, so can I just ask a follow-up question there? And it's really timely because it's kind of challenging my view, which sounds a little similar. That is, small cap value stocks have sold off sharply in the past couple of weeks. But it sounds to, and I don't want to put words in your mouth, Jim, but are they screaming buys right here, as you're saying, or is the market telling us to stay big, growthy, and defensive, and that kind of philosophical tech trade?
I think that when the Fed eased, we set off a cyclical run. Right now, that was augmented by Trump winning and other things, but that certainly set off a cyclical run, a small cap run, aggressive. If you look at low quality to high quality stocks, all of those rallied big. To your point, Tally, those are all now rolling over, and they dovetail with the rollover. And guess what? Citigroup's Economic Surprise Index. So you look at low quality, high quality, it's rolling. You look at the relative performance of S&P defensive sectors. It hasn't come up much, but the cyclical sectors have certainly rolled over big time, particularly the deep cyclicals like materials, but also even financials and consumer discretionary starting to roll just a little bit overall.
That's actually my contrarian play for 2025, materials. We'll see you in a year, Jim.
So I guess what I'm saying is, depends how cute you want to get. If I think about the whole year of 2025, I think I'm going to sit in value in cyclical stocks. Not only that, but I mean, I'm going to be overweight.
I like this guy. He's speaking our language.
If you're going to get a little more cuter, and maybe I try to do that on the margin, most of what I do, I think the important thing is investment. I think it's important to realize that probably 85% of what we're hired to do, the market does for us. And it's our job not to screw that up.
Yeah.
That is to say,
screw it up.
Be in there and let compounding be.
Yeah.
We just play with that little 10 to 15% piece. And don't ever go outside of that, quite frankly, because the beast is too big relative to you. It'll run you over. So, but of that 10 or 15, I may go a little more, defensive right now. The defensives have gotten really chewed up. They haven't yet really come back. And cyclicals are starting to roll. And maybe I take some of my star cycles like consumer discretionary and move it into staples or healthcare, something for a little while. And then as we blow in and when you feel that everyone's getting worried about recession again, then I might take that move back into the, but
you're a better market timer than me.
Feel like you're too cute, by trying to do that.
Yeah, too cute.
So Jim, I wanted to ask you about all of this maturity wall that the U.S. government has, like all these bonds that are coming due that they have to refinance. What's like, and it still boggles me to understand why, when Janet Yellen was the Treasury Secretary, we issued tons and tons of T-bills, not a lot of long-term bonds when rates were really, really low. Sometimes it feels a little bit like a shell game, right? With what the Fed is doing and what the Treasury's doing. Are we, is Trump going to try to manage this to get rates lower? What does the Treasury do and what do they issue? I'm just curious, kind of your thinking about that.
Well, I've never been a big one on worrying about the government too much. When I started in the early 80s, right away, we had the Reagan deficits, which at that time is percent GDP. It went out to 6% by the middle 80s. We thought the world was over. And it was the biggest peacetime deficit ever. People thought that, a lot of people stayed out of the market and they did everything. And I've seen that same sentiment come up time and time again. And I usually ignore it. I think it's never worked that I've seen. I don't think the government's going broke. I don't think we're anywhere close to being Greece. I think we could have debt ratios go a lot higher and still not be Greece. If the U.S. was ever going broke, the rest of the world would rush to the U.S. for safety. That's kind of what would happen, I think. I'm just not too worried about it. In fact, I just put a piece out within the last month to 2 months that looked back historically at the deficit to GDP ratio. And what I found was that the stock market, forward returns in the stock market, annualized, do the best when you have the largest deficits to GDP ratio, and the worst from the lowest deficits to GDP ratio. If you think about it, when Clinton went to surplus by the end of his term, what happened? .com.
Yeah.
And so, in the whole time, I don't really see where it's a problem. I mean, I know the interest burden's up, but it's still lower than the record highs in the 80s. And I think that takes you down a bad street. I think there's so much flexibility. If I could tax all you guys whatever I wanted to, whenever I needed to, I would never get in trouble either.
Is Doge then a potentially bad idea for the stock market?
Yeah, I was thinking the same question.
I'm not a real expert on that. You're talking about the Bitcoin?
No, Doge says that lower government spending.
The Department of Global Efficiency.
You're talking about Musk. You're talking about Musk. You're talking about a Bitcoin variant. You're talking about Musk.
Yeah.
I'm a little worried about what they do, but my feeling has always kind of been that I like split power. I'm not very political, and I like split power. I think our founding fathers wanted that. They moved this kind of thing. The last thing they wanted was what they left, was a tyrant. They didn't want anybody in control, so they created this almost comical structure. Put 450 guys over here and 100 over here and this one person over here in this White House. If you guys all agree on something, let me know. Otherwise, we'll let laissez-faire handle things.
I love that.
And that's typically what they wanted most of the time, and I think it works best when you do. And it could be better, but I think it's good that the House spread is very tight, and I think it's going to really limit what Trump and Musk and company can really do. We just saw a little bit of that here just in the last week, right, when they couldn't pass Trump's budget bill. So I'm not too worried. The talk can scare you sometimes when you listen to it enough.
Right.
If they really start to take, and there's some good things in that. There's some things that would be good if we cut some of that stuff, I think. I do. I think that would probably be okay. It's okay if we don't. I don't think it's the end of the world either way. But if you do it too quickly, that could be a problem. I hate his tariff idea, but he's not going to implement what he's talking about there, because that'd be a death blow for world growth. But so it'll be something far less than that. I think he's using that stuff as bargaining chips to negotiate with foreign players.
Sure,
he's more bargaining place.
Yeah, the art of the deal.
Art of the deal.
Yeah, I think that's
exactly.
what he's doing.
Yeah.
But I guess I think that if you go down that route, you'll probably end up making bad decisions that you shouldn't make. Just like the Fed, the Fed's been out of sync forever, and yet it's still worked out because laissez-faire is kind of really the one driving the boat.
Is it possible to get a position called Chairman Emeritus of our investment committee and give Jim Paulsen the job, even though he's never worked here?
No.
Change it. Job, Jim. It only requires 1 hour a month.
Yeah. By the time I become Chairman Emeritus, I'll run your firm right in the turf.
Are you a Des Moines guy? Are you from Des Moines?
No, I'm from a small farm town in eastern Iowa called Durand. It's a little bitty small town just outside the Quad Cities. And my father owned a farm there, and he also worked at the local bank. So it was a good way to grow up. I don't know if I'd want to live there, but we grew up in a large family, and it was a great way to grow up. I'll say that.
We have an office in Des Moines. I love it there. And are you in Minnesota now? Where do you live?
I am in the western suburbs of Minneapolis, and I lived in Des Moines for 6 years? Yeah.
Okay.
Yeah.
I got one last question for him, and then we'll let Tally and Jim wrap it up. But what are you into personally? What are your hobbies? What are you doing nowadays?
Well, my hobby is the markets. I mean, it is. I like my wife likes crossword puzzles and other things, and I like this puzzle. I just have fun with it. The only reason I retired a couple of years ago now, and about in February of this year, if I decided I was still looking at stuff almost every day for a little while, and thought, well, I might as well write up some of these ideas.
You're on Substack, right, Jim?
That's how I got on Substack, and Paulson Perspectives at Substack, and I just put out 1 or 2 pieces a week, and my whole goal was I wanted to get enough subscribers to pay for Bloomberg, and I've done that, and I don't care about anything else, and I enjoy that, and I like sports a lot. I work out most every day. I like working out. I've tried a little pickleball here with.
I got a deal for you. Tally just asked for his own Bloomberg because Jim's got one, and I told him, hold on, be patient, but we'll get you one for that role, Chairman Emeritus. We'll pay for it. Talk about
Thanks.
Yeah,
I'm
cash flowing. I didn't want to tell my wife my hobby isn't cash flowing, so I had to tell her I cash flowed that. But
Bloomberg is not cheap. I know that.
Oh no, it's not. You need a few subscribers.
You get a lot of information. It's good information.
Oh yeah, it's fun. Well, and I've used it for a lot of years. You just old dog do trick.
Yeah,
kind of thing.
Exactly.
Keep calling me, the reps. They're like, hey, where are you? We don't see you on the platform anymore.
Hey, Jimbo, take us home here. Is there anything else we want to ask Mr. Paulson?
So my final question, and I've been asking this a lot, just with AI, all of this information, things are happening so fast, and we have these AI factories that are getting built. They take up the amount of energy that a large city would take up. I mean, it feels like a lot of that would be really disinflationary. It would be really good for a lot of people, but do we have the infrastructure to support it? We're still, as yet to be determined. I'm just curious, whatever your thoughts are on all of this, because it's you've seen a lot. I mean, from starting in the 80s, and you saw the tech bubble and the internet kind of be born, and what do you think?
Yeah, that's the one of the advantages of being an old guy. You've seen a lot. In fact, when I started in Cedar Rapids in '83, it wasn't until '85 that the PC came out, right? PC wasn't even out. And boy, when that hit, we had one PC in the entire company, and I had my floppy disk, and I'd get 2-hour usage time in the day. And I'd go in the middle of the night or a weekend to use it more. And I thought this was the best darn thing ever. I was doing models of valuation models on an HP 32E calculator.
Yeah.
With
I
the
still have
script.
mine.
They had script that went through it. And I say we would work all day, and we never had any ticker tape or any kind of information about what the stock market was doing whatsoever. And we just read annual reports and did our research. The only time I ever knew what the market was doing was we went to lunch and we walked by the local bank, and they had one of those digital readouts on the Dow Jones, and we'd find out whether it was up or not. So we've come from that kind of methodology to where it's information overkill today, almost too much to even digest. But I think that the innovations are utterly mind-blowingly fantastic. And the fact that the United States sits at the epicenter of this and has since the early 1990s, you got to remember, Japan, for example, ate our lunch with innovations in the 80s. And we were getting mad because they were coming over to California buying up our golf courses, and finally they went south, and we've kind of dominated the world ever since. And I don't see that shutting down anytime soon. It's pretty phenomenal. And the thing I think's the most dramatic about these innovations, the innovations today are not like innovations of old. When we created the automobile, 19 teens or 20 or whatever, that thing essentially does the same function today that it did when we invented it. It's got 4 rubber wheels and takes you places, and really nothing's changed. The airplane pretty much does the same damn thing it always does. So does fire. But you think about what's changed when we came out from a calculator to my own PC to an integrated internet with data to AI now, or robotics, or these are things that are doing something today that are being done by these companies. In 5 years, we won't even recognize that company from our eyes today. It will be doing something entirely different. Ford Motor's still doing the same thing. These companies aren't and won't be. And so it's like the innovation on steroids is something, and I think it's affected so many things. The valuation range of the stock market is totally messed up. Ever since the 90s, it's been permanently elevated at a higher range after 130 years of being in the same range.
Yeah.
If I look at a ratio of profit, real profit of corporations per job in this country, it was in the same range bound from 1950 to early 90s, and now it's exploded fourfold.
Wow.
Out of there. There's just all kinds of things in the background. I think a lot of the problems we're having with a lot of our old economic indicators, statistics, is that they're just totally washed away in the new era environment, and it's getting worse. A lot of people make a big deal out of the market cap being so much higher relative to GDP in this country. The companies that make up that market cap probably sell most of their stuff to somebody else's GDP. I mean, we really have to compare these values to global GDP to get any sense of it, because a lot of those markets are big. So just in so many ways, I don't see it stopping. The interesting thing will be is if we can maintain a dominance. It doesn't look, I can't imagine who's going to rise up right now, but at some point we probably will lose our dominance there. But it's a luxury to have that. And I think we're going to have to change a lot of things, including like our 11 sectors. I mean, we're going to have to change those definitions.
I remember when it was 10, they keep changing them. I wish they'd stop changing them. But, I was just going to chime in your point about tech and speed. Jim Warden sent a really interesting article around about the speed of quantum software now. And that's not sci-fi.
Wow.
That's now.
You guys don't need those stocks?
That's already happening.
Yeah. Those
It's
quantum
mind-boggling.
stocks have just gone bananas.
They've taken off.
And you were talking about the amount of power it takes for AI, but think about quantum now of reducing power need.
Yeah.
What it can do for what something back not that long ago, would take tremendous amounts of power. So,
gentlemen, for me, this was an awesome podcast interview, Jim. When you were with Luthold, I would watch you on TV a lot, and I always knew that you were smart. But man, I really like you now. So this was a great. Thank you for doing it, Jim. Thanks for getting them on. Tally, guys, it was awesome.
Here's Three's Company too. Come and dance on our floor. Take a step that is